Hello. Today I'm going to be sharing some charts for my holdings in my portfolio at the close on February the 13th, 2026. I'll share with you what I am observing on the charts and how they help me form any decisions for these holdings. We'll begin with a general market overview, upcoming earnings for holdings in my portfolio, and overall portfolio performance. If you like videos like this, please subscribe to the channel and set notifications for future videos. Also, be sure to press that like button to help support the channel. Let's get started. Let's set the stage with a general market overview and action from this past week. So the semiconductor index did outperform this past week. It was up 1.11%, followed by the equal-weighted S&P 500, which was up just over 0.25%. Other than those two major indexes, everything else was in the red, including the mid-cap, small-cap, the Dow Jones Industrial, the NASDAQ 100, the S&P large-cap, and the Dow Jones Transportation Average was actually at the top of the list last week, but it is trailing this week, down 2.76% overall. Let's take a quick look at the sectors. The utilities outperformed overall. They were up 7.27%, followed by real estate, which was up 3.6%. And we're looking at a 1 week view. Materials were up nearly 3.5%, followed by energy at 2.07%. Consumer staples were up 1.8%. The industrials were up a little over 0.5%. Then we move into the losers last week. It was healthcare, communication services, technology, followed by the S&P 500, and then trailing the S&P 500 was the consumer discretionary sector and the financial sector. So what we saw last week was a lot of defense moving to the top of the list. Utilities is definitely a defensive sector. Real estate is. Materials is somewhat neutral. Energy, consumer staples is defensive. Industrial is more aggressive, but it was definitely defense that was strong in last week's trading. We'll take a look at the S&P 500. It's pretty much been trading sideways since October. Has been trending slightly up, but pretty much flat since the end of October. The one thing I want to point out here is the put-call ratio. So we can see the darker of the two blue lines here is a 5-day moving average of the CBOE options equity put-call ratio. As that ratio moves higher, we see that market participants are buying more puts than they are calls, and that's somewhat defensive. They're expecting somewhat of a pullback in the market, and they're buying some insurance to protect themselves from that downside. The lighter of the two lines is the daily raw data. We can see that we spiked up last week, and it has been trailing down slightly, but the overall 5-day moving average is moving a little bit higher. On the S&P 500, we can see that we're below 50 for the RSI, and we did get a move into bearish territory on the black line of the PPO, and it is trading below the signal line at the moment. Money flow is pretty much neutral and has been for the last 3 or 4 trading days. If we move to a weekly view on the SPX, We can see that the RSI has dropped down below 60 after being close to 70 back in September and October. We haven't quite been able to reach those levels since the end of October. So we are losing a little bit of momentum and relative strength on the S&P 500. We can also see that the PPO has been trailing downward. On the weekly view, it is still in bullish territory, and we have money flow that is still showing bullish money flow. We'll do a quick comparison of offense versus defense. So once again, we have the S&P 500 in the top panel, and then the next panel we have growth versus the S&P 500. So the QQQ has more growth in it than the S&P 500, although the S&P 500 still has some growth components. But one of the things that we see is a decline in the overall relative strength of growth versus less growth. When we look at the consumer discretionary versus the consumer staples, we see a very similar trend where the relative strength of discretionary is less than that of consumer staples. Then we'll take a look at large cap growth versus large cap value. We see a very similar trend where value is outperforming growth. So growth has less relative strength than value at this point. Then we'll scroll down to the Morningstar mid-cap growth versus the Morningstar mid-cap value. And we see that this goes back even further. Growth had relative strength compared to value clear back to July, but since that time we've seen the relative strength of the growth components lose to the value components. Then this is small cap growth to small cap value. We see a very similar trend where the growth has less relative strength than value. Then when we look at technologies compared to utilities, utilities is definitely a safety sector. Technology is very aggressive. Technology had really been outperforming on a relative basis utilities, but what we see since the end of January is a very sharp decline, moving into more safety-related components. Next, we'll look at a comparison of the XLY, which is the discretionary sector, versus the XLP, which is the staples sector. So typically when the S&P 500 is rising, we see the discretionary sector on a relative basis outperform staples. These are things that we want in the discretionary sector versus the things that we need, which are in the staples sector. But what we see right now is the S&P trading somewhat sideways, and the relative strength of the XLY, the discretionary sector, is underperforming that of the S&P 500. And that's what's really hurting the S&P 500. It's just been trading sideways basically because we do not have much relative strength in the discretionary sector. Then when we look at discretionary in an absolute term, we can see that it's pretty much been trading sideways. But when we look at the XLP, the staples, we can see that it is really outperforming on absolute terms. So the XLP staples has been able to keep the S&P 500 from declining because of the strength that we see here. But typically it's not enough to carry the market overall because this is a much smaller portion of the S&P 500 compared to things like technology and the growth components. Finally, we'll take a look at the VIX. We can see that it spiked up to over 21 on February the 5th. We came back down to levels around 17, which are still cautionary. We traded sideways for a few days, and then we had a big spike again in the VIX on Thursday. It trailed down slightly on Friday, but we are still above what is very cautionary level of 20. So we'll need to keep an eye on the VIX. With the VIX this high, buying puts as insurance is pretty expensive. But if you want to sell puts on any holdings, you also get some really good premium if you're willing to take that risk on some stocks. So the premium is higher if you're selling those stocks at the moment. We also have some economic reports that'll be coming out this week. Monday the 16th is a U.S. holiday, so the U.S. markets will be closed on Monday. On Tuesday, February 17th, we get the ADP Employment Change Weekly. On Wednesday, we'll get mortgage applications. We'll get data for November and December regarding building permits and November and December housing starts. The FOMC minutes will be released, so we'll get to look at some of the details of the meeting and some of the decisions that they were looking at. Then on Thursday, we get initial jobless claims, we get continuing jobless claims, and then Friday is going to be a big day full of economic reports. We get the PCE, which is the Federal Reserve's preferred measure of inflation. We'll also get the core PCE. We'll get the Q4 GDP growth rate. We'll get personal income for December, personal spending for December, November and December new home sales. We'll also get the February Michigan Consumer Sentiment Report, and this will be the final version for February. And then another potential market mover could be the U.S. Supreme Court ruling on the IEEPA tariffs. That is expected to be released this Friday, so we'll need to keep an eye on that as well, because that could definitely be market moving. I do have some holdings that will be reporting this week. GMAB I actually don't hold at the moment. I sold out of that at the end of December, but I am still monitoring. This one tends to have a pretty poor performance on a seasonal basis during the first quarter of the year. So I sold this, and it is declining in price, and towards the middle to the end of March, I'll be picking back up this holding because it does perform really well in April on a seasonal basis. But I also have Jackson Financial reporting. I have a REIT MPT reporting, and I have two financials, F&G and also FNF reporting, and WBD, which is in acquisition talks at the moment to be picked up by either Netflix or Paramount. That is ongoing as well. So we'll be watching these this week to see how they report in their earnings. My portfolio overall through the close on the 13th is holding up pretty well. I manage 3 accounts. The brokerage is up 5.5%. The Roth is up 3 3.1%. The IRA is up 4.6%. And when I combine all three of those together, I'm up about 4.5%, while the S&P 500 is down 0.14%. I did have 3 holdings this week that hit all-time highs during trading. I had 11 that hit 52-week highs this week, and I had 27 holdings that hit 13-week swing highs. And then back on December the 12th in my weekly review, I shared that FactSet had a bottom-up target price for the 11 sectors, that real estate would be second only in performance to the information technology sector. So I am going to be showing some REITs today because they are performing very well in this cautionary market. So on December the 12th, when I put out that previous weekly review, I did include ADC, and they were closing at lows at that particular time. But I had a price target on them of $77 to $78. They did finally complete their consolidation, and we had a breakout above a downtrend line, and we also began closing above a longer-term uptrend line. And at this point, we had 2 points of resistance, one around 76 and another $76.61, and it did close Friday up 1.96%, which was a 52-week high, and year to date they are up 8.4%. There are 10 analysts that cover Agree Realty with a 1-year price target of $81.05, with a range between $75 and $84.50. They do pay a dividend of 4.03%, and they have a 5-year dividend growth rate of 3.42%. They are trading above their upward sloping 5-day moving average. They're above their 21-day moving average, which is upward sloping as well. The 50-day and 200-day are also upward sloping, and all of these averages are in the proper order. On the REITs, I keep a very close eye on the 10-year Treasury rate because they are very sensitive to that particular rate. The 10-year has dropped down to about 4.05. We're not quite at the lows that we saw at the end of last year, which was around 3.95, 3.96 or so. And it is currently below its 200-day moving average. We also have an RSI that is bullish. It's moving above the 70 line at the moment, so it's moving into overbought territory. We received a buy signal on this one on the 3rd of February, and that strength in the PPO is continuing to be stronger each day over the past couple of weeks. When we move to the weekly chart for ADC, we can see that they haven't quite reached 70 yet. They're currently sitting at 67, so on the weekly data they haven't moved into overbought territory. And we also got a buy signal about the same time as we did on the daily chart, the 2nd or 3rd of February, and this is getting stronger, and I think we have a little bit of room to run here. We do see that money flow is currently bullish. They were up 4.47% for the week, and that was also a 52-week high for a closing price for the week. This is Amazon in the 1-year daily price chart. They had been in a consolidation price trend, but they started into a distribution trend after their earnings report. This one ranks 21st in my portfolio. They have an intrinsic value of $284.63. They did close down 0.41% on Friday, and that was a 65-day swing low. There are 44 analysts that cover Amazon with a 1-year price target of $279.59, with a range between $175 and $325. Amazon is down 13.4% for the year to date. They are trading below a downward sloping 50-day. The 200-day is still increasing, and they are trading below a declining 5-day moving average. I did pick up a few shares on February the 6th on this price drop, but I'm going to hold off on any additional shares until I see where they settle out. They have broken down below these two green support lines, and they sustained that at the Friday close, so I think this one may have an opportunity to be picked up at a lower price. Lots of volume, quite a bit above the 50-day moving average for the past 2 weeks, basically. It is oversold at the moment, and the PPO is declining, and it looks like the difference between the black line and the red line is getting larger based on the size of these histogram bars. If we go to the weekly view, we can also see that they are trading in an RSI of about 37, so they've broken down below the 40 line, and we got a sell signal on Amazon on the 26th of January in the weekly view, and I also am seeing a little bit of distribution here. Money flow is currently in bearish territory. If we look at Amazon in fast graphs, we can see that they're trading at a blended PE of 27.46 times. They have an EPS yield of 3.64%. They do not pay a dividend. If we look at 13 years worth of data, we can see that they've grown their adjusted operating earnings growth at 54.66%. That gives them a fair value ratio of 54.66, and they have a normal PE ratio, what the market typically applies to Amazon, at 98.22 times. And the biggest concern of investors right now is just the amount of CapEx that they're spending to grow their AI capabilities in AWS. They are expected to grow their earnings in 2026 by 8%, 22% in 2027, and 23% in 2028. We can see that they're trading below their fair value and their normal market multiple, but this is one I'm going to hold and wait for things to settle out a bit before I pick up any more shares of Amazon. This is ARCC in the 1-year daily price chart. They have a portfolio rank of 19 in my portfolio. We can see that they are overall in a downtrend. They have a book value of $19.94. That's this blue cyan colored line. There are 9 analysts that cover ARCC with a 1-year price target of $22.11 and a range between $20 and $23.50. We did have a sell-off at the middle to end of 2025, and that was basically on concerns about credit default risk. And then we had another fund from BlackRock that reported a 19% reduction in their net asset value because of credit concerns. So that reignited the credit quality worries. If you want more details on that, you can look at my ARCC earnings preview video that I posted on February the 4th. And then this past week, there were some additional discussion about credit to software companies that is leading to potential credit losses given the AI impact on software companies recently. They do have a dividend yield of 9.91%. They have a 5-year dividend growth rate of 3.71%. We look at them in the weekly chart. They are trading an RSI right around 40. The PPO has moved into bullish territory, and we have received a little bit of distribution. The money flow is currently bearish. They were up for the week 0.31%. They are down 4.25% for the year to date. I did sell 2 put contracts with a $19 strike that expire this Friday, February the 20th. If they don't get below $19, I'll get to keep that premium of 26 cents per share, and I have a contract that's covering 200 shares. If it drops below $19 by Friday, then I'll pick up a couple hundred more shares of ARCC, as they do trade below their book value at the moment. This is Maplebear, symbol CART, doing business as Instacart. And they've had a pretty bad string of negative news on them, which really drove the prices lower. We did have a small recovery and then a swift decline in the prices. It broke down below support, but it has recovered after their earnings that they reported on February the 12th. They did beat on revenue and earnings, and they guided between 11 and 13% growth in their gross transaction volume. So they did close up 9.21% following their earnings. They are still down 19.3% year to date. There are 23 analysts that cover Instacart with a 1-year price target of $52.61 and a range between $50 and $65. I have an intrinsic value calculation of about $50 on them. They are trading below a downward sloping 50. They did close above a downward sloping 21-day moving average, and they did close above what was a downward sloping 5-day but has begun turning upward. They did close above that 5-day moving average. They have an RSI of 44. Their PPO has been in a sell signal since about the 17th or 18th of December. I am seeing a black line that is starting to increase and could cross above the signal line. That would give us a buy signal on the PPO. That would be confirmed by consistency of the RSI above 40 and across above 50. Looking at the weekly data, they did close up 4.79%. The RSI hasn't quite gotten to a level of 40 yet. We've been on a sell signal since about the 12th of January, and money flow is currently neutral. Next, we'll look at Centene, symbol CNC, in a 1-year daily price chart. So this one's had some struggles. They had a pretty large drop back on the 2nd of July when they pulled their full year guidance. They continued drifting down until August, but they are up about 62% from that August low. This one has a portfolio rank of 28 in my portfolio. Overall, they're in a price consolidation with a slight downward bias, but this past week they did start moving a bit higher. I was selling covered calls on this one during this period, but I am switching to selling cash secured puts. Last week I had sold a put with a strike of $38.50 expiring on Friday, and that was for premium of $30. That did expire worthless, so I was able to keep the premium. When I look at the options chain for this week, we are closed on Monday. But if I look at that 38% or $38.50 put, that has a delta of 20. They have an implied volatility of 49%, and those were selling for 34 cents per share, which would be $34 in premium. So I am looking to sell that particular cash secured put when the market opens on Tuesday. I have a blended intrinsic value of for CNC of $20.07, and that's basically on significantly reduced free cash flow. But if we look at their valuation using earnings growth, they have a value of about $40.89 per share. They did close above a declining 200-day moving average on Friday. They were up 3.57%. There are 16 analysts that cover Centene with a 1-year price target of $41.19 and a range between $28 and $61. Year to date, they are down 1.39%. The 200-day is still declining. The 21-day is also declining. They have an RSI of 45. The PPO is in bearish territory, but does look to be improving slightly. When we look at them on the weekly chart, the RSI is right around 50. The PPO, we are getting a sell signal in the weekly view in bullish territory, and the money flow is positive. And I do see a bit of accumulation in this particular company. We can also see that CNC closed up 5.51% for the week. When we look at them in fast graphs, they have a blended PE of 18.52 times, an EPS yield of 5.4%. They do not pay a dividend. Over this 13-year time frame, they have grown their operating earnings growth rate at 11.45%. Fastgraphs calculates their fair value ratio at 15 times, and their normal PE is 15.14 times. They did have a pretty significant decrease in earnings in 2025, but they are expected to return to growth in 2026 at 44%. 37% for 2027, and 51% for 2028. This is Costco in the 1-year daily price chart, symbol COST. They have a portfolio rank of 23 in my portfolio. They do have a price trend that is showing accumulation overall. They did close up 1.96 on Friday, which was a 65-day swing high, and they are up year-to-date 18.11%. There are 20 analysts that cover Costco with a 1-year price target of $1,016, with a range, pretty wide range actually, of $230 to $1,225. I do have 2 resistance points here that I'm watching. The first one is at 1,062, and that was from the high on June of 2025. And then I have another at 1,072, which was the February 2025 all-time high. I have a trim point on them of about $1,008, and that's based on the Chandelier exit, which had a high back in July of 2025 of that $1,008 price. So now that it is recovered above that price, if it moves higher, I'll continue to watch the Chandelier exit. I'll go ahead and continue to ride this one up. But if it drops below the current Chandelier exit that I have highlighted here, then I will trim at that point. They are trading above an upward sloping 5-day moving average, 21-day moving average. The 50-day is below the 200, so those are in the reverse order. The 50-day is moving higher. The 200-day has stopped declining, and it is flat to maybe slightly rising. It's currently sitting at $949. They have an RSI that's approaching an overbought condition. The PPO is in bullish territory. If we look at them on the weekly view, they closed up 1.73%. That was a 13-week swing high. The RSI is sitting at 62. We had a buy signal on the 5th of January. That continues to increase and is getting stronger. And we're also seeing accumulation starting to move higher as well. The money flow is currently in bullish territory. If we look at Costco in fast graphs, we can see that they are trading above their normal market multiple, and their fair value is calculated by fast graphs by a pretty wide margin. So this one is overpriced, but it has traded at a premium for quite a few years. They are expected to continue growing their EPS by 11% in 2026, 9% in 2027, 10% in 2028. This is CRMD, CorMedix, in a 1-year daily price chart. They are in an overall downtrend, but they did find support at this $6.80 level. They're on a declining price trend over the last couple of weeks. We'll see if they can maintain this support level. I have a price target on them of $14. I have a blended value of $25.07. There are 7 analysts that cover CorMedix with an average price target of $15.29 with a range between $12 and $22. Year to date, they are down 36.89%. They did have their investor day on February the 10th, and that could have been a potential catalyst. The one question I was looking to get answered out of that is, can management prove that the patient growth related to their principal product was it strong enough to overcome the TDAPA reimbursement hurdles that they face beginning in June of this year? And it looks like maybe analysts and investors were unconvinced, so they did trade lower over the next couple of days. The 200-day is flat to declining. The 50-day is declining. The 21-day is declining. They're trading right at their 5-day moving average. They did announce on February the 2nd that they would have a $75 million buyback authorization through the end of 2027. I think that accounts for about 10% of their stock count. If we look at them on a weekly basis, we can see that they're right at the 40 RSI, currently 37.88. We did get a sell signal on them on the 5th of January, and they're currently in bearish territory. We have seen distribution, and the money flow is currently negative. On January the 14th, I did sell a put with a strike price of 70 that expires this coming Friday. So as long as it stays above $7, I'll be able to keep that premium. If it trades below $7 by this Friday, then I will own another 100 shares of CRMD at $7 minus my premium. This is Entergy Corporation, symbol ETR, and this is my utility provider here in Arkansas. And I bought them initially because I wanted to own them to receive dividends that I could use to pay my utility bill while I'm in retirement. And they have absolutely done that for me. What I was not expecting from ETR is that they would become an AI darling about the time that OpenAI was released and utility companies became a play in that AI, that they would shoot up, over 100% over the last couple of years. So I have a couple, or actually 4 breakout points here. So basically from 2021 all the way through 2024, they were just consolidating. And with the AI in play, they had a breakout. They rose pretty solidly, and then they consolidated once more, had another breakout, consolidated, breakout, consolidated once more, and they broke out to an all-time high on Friday. They were up 3.05%. So this is a blue sky breakout as of February the 9th. Year to date, they are up 13.68%. Now, on these breakouts, I want to highlight the RSI. So when we got the breakout, notice that the RSI got above 50 and pretty much stayed above 50 all the way until it began consolidating once more. Then the RSI oscillated around the 50. We got another breakout. They were above 50. They stayed above 50 until the next consolidation point. Then on the next small breakout, they got above 50 again, stayed above 50. They broke down below the 50 line and consolidated and moved a little bit lower. But now they have broken out above that 50 line again, and that seems to be increasing at the moment. So we'll keep an eye on this RSI level moving forward. So this is ETR in the 1-year daily price chart. We can see that they broke out on February the 9th above their previous high, and this is a blue sky breakout. I did sell 20 shares at $105.40 on Friday near the high. They did close up 3.05%, which was an all-time high. They pay a dividend of 2.44%. They have a 5-year dividend growth rate of 5.7%. There are 17 analysts that cover ETR with a 1-year price target of $103.18 and a range between $86 and $119. They have a portfolio rank of 5 in my portfolio. We'll move to the weekly chart, and in the weekly view, they also are at an all-time high. They were up 7.96% this week. When we look at ETR in fast graphs, we can see that they are very extended above their fair value and their normal market multiple. They do have EPS growth of between 11 and 12% expected over the next 3 years. This is Alphabet, symbol GOOG, in a 1-year daily price chart. Alphabet has a portfolio rank of 20 in my portfolio. They are down 11.2% from the closing high on February the 2nd, so that does put them in correction territory at the moment. I have a blended value calculation on them of $319.83. They are overall in a consolidation price trend. What has frightened investors is the amount of CapEx that they expect to spend on AI data center growth. They're expecting to spend $175 to $185 billion. There are 44 analysts that cover Alphabet with an average price target of $348 and a range between $190 and $420. I have had some concerns about this particular holding for quite some time. So we had continually rising prices, but we had a bearish negative divergence on the RSI and a bearish negative divergence on the PPO. It took quite a while before the bears did actually take over, but we did have this 11.2% decline over the last couple of weeks. The RSI has moved below 50, currently sitting at 32, and the PPO has moved into bearish territory after receiving a sell signal on the 4th of February. And if we go back even earlier, could have been as early as the 5th of December. They are finally trading below their 50-day moving average, which is declining. The 21-day is declining and the 5-day is declining. The 200-day is still increasing, and they had been trading significantly above the 200-day moving average. But as we lose the price, we are getting closer to that 200-day moving average. We are currently 25.71% above the 200-day, and that is decreased from 34.82% last week. My stop loss using chandelier exits is set at $325. So I did do a little bit of trimming at 312, 10 shares. I did pick up 2 additional shares at 309.30, and I'm going to wait for this one to settle out as well before I continue adding more shares because the selling is definitely picking up. I do have a support line around $299. I'll have to keep an eye on that and see if it does maintain that support. If it breaks down below that level, then the next level would be about $280. Last week I did mention I was going to see if it could maintain the 50-day. It did not. So we do now have a sustained break below the 50-day. The RSI also dropped from 70 down to below 50. Actually got down to 44 in 1 week, and that was the lowest level we had seen since June of last year. This week the RSI has dropped down to 32, and that's the lowest that we have seen since the tariff announcements. Year to date they are down 2.48%. When we look at them in the weekly view, they were down 5.29% for the week, and that was following a 4.56% drop last week. Next, we'll look at Hess Midstream, symbol HESM in the 1-year daily price chart. This is one I've been adding to pretty significantly after they had a pretty significant price drop on the 19th of September. I have a blended intrinsic value on Hess at $47.31. Overall, they're in a bit of consolidation. On February the 10th, they did hit a swing high, 65-day swing high. And then on the 13th, they repeated that with another 65-day swing high. They do have a dividend of 8.33% and a 5-year dividend growth rate of 11.05%. Year to date, they are up 6.32%. There are 7 analysts that cover HESM, with a 1-year price target of $41.43 and a range between $36 and $48. We look at them on the weekly chart. The RSI is pushing up towards 60. We got a buy signal on the 1st of December in the weekly view, and they have moved into bullish territory, with the strength continuing to build in the PPO. The money flow is currently positive. We look at Hess Midstream in fast graphs. We can see that they are trading below their fair value and their normal market multiple. They have an EPS yield of 7.81%, a dividend yield of 8.33%. Over this time frame, they've grown their operating earnings growth at 13.58%. Fastgrass has a fair value ratio at 15 times. Their normal market multiple is 15.42 times. They are a slow and steady EPS grower, expected over the next 3 years. This is Johnson Johnson in the 1-year daily price chart. They have a portfolio rank of 14 in my portfolio. They are in an overall uptrend. They are trading above an upward sloping 5-day, 21-day, 50-day, and 200-day moving averages. I have a blended intrinsic value on them of $202.99. That's indicated by this cyan colored line. On February the 12th, they did hit an all-time high. They pulled back slightly on Friday. There are 17 analysts that cover J&J with an average price target of $227, which we're trading above that currently. They have a range of $153 to $265. From a seasonal performance perspective, J&J is normally somewhat neutral in the first 6 months of the year. However, J&J seems to be bucking that trend this year. They are up year-to-date 17.64%. They do have a dividend yield of 2.14% and a 5-year dividend growth rate of 5.25%. I do have a trim point set on them at $235.36. That's the orange line. The RSI is in overbought territory. We've been on a buy signal since the 13th of January on JNJ. That is in bullish territory. Does seem to be weakening just a little bit. When we go to the weekly view, they've been pretty much in an overbought condition since the 11th of August of last year. The PPO has been mostly on a buy signal since about the 7th of July. We did have a short period here where we had a sell signal in bullish territory. The money flow continues to be positive. This is Meta in the 1-year daily price chart. So they did have a nice bounce on the 29th of January, but they've been in a decline since that point. They have a portfolio rank of 26 in my portfolio. I have a blended intrinsic value on Meta at $1,035.98. Overall, they are in a downtrend. There are 40 analysts that cover Meta with a price target of $838.08 with a range between $645 and $1,144. They are down 13.35% from this recent high, so they are in correction territory at this point. Year to date, they are down 3.08%. I do have support at $603.10, and then the next support level would be $587. Their 200-day is still increasing. Their 50-day is increasing. The 21-day has rolled over and is decreasing, and they did close on Friday below their 5-day moving average, and they are trading right at my average cost per share. The RSI has been decreasing since January the 29th, currently sitting at 42. We did get a sell signal on about February the 9th, but we are still in bullish territory on the PPO. When we switch to the weekly chart, we can see they were down 3.28% this week, and that was following a 7.68% decline last week. We look at Meta in fast graphs. They're trading right at their normal market multiple. They're trading above their fair value. They are expected to grow their earnings 26% this year, 15% in 2027, and 17% in 2028. Next, we'll look at Altria Group, symbol MO, in the daily 1-year price chart. This is a consumer staple. They recently formed a cup with handle pattern, and on February the 6th, I calculated based on that pattern a price target of $72.50. I did go overweight on them by 50 shares at $65.59. That was on the 5th of February. I am going to hold those until we get closer to this price target. They do have positive momentum. They're in an accumulation phase at the moment. I have a blended intrinsic value on them of $73.65. They did close higher 4 out of 5 days this past week. They are up 16.63% year to date. They have a forward yield of 6.30%, and a dividend, 5-year dividend growth rate of 4.12. There are 8 analysts that cover Altria with a 1-year price target of $62 and a range between 50 and 72. I have a trim point on them at $63.77 based on the chandelier exit. They are trading above an upward sloping 5-day moving average, 21-day moving average, and we did get a 50-day crossing above the 200-day this past week on February the 12th. That's referred to as a golden cross. We are moving into overbought territory. We've been on a pretty much a buy signal on them since about the 17th of November. A more powerful buy signal on the 12th of January. We look at them in the weekly view. They were up 2.83% this week. The RSI is in overbought territory on the weekly view. And we had a buy signal on the 12th of January, and that is getting stronger, that PPO. As we move forward, that momentum is getting stronger. We look at Altria in fast graphs, we can see that they're trading below their normal market multiple and their fair value as calculated by fast graphs. We have an EPS yield of 8.12% and the dividend yield at 6.33%. This is National Retail Properties, NNN. This is a REIT. They are nearing an all-time high of around $45. They are trading above an upward sloping 5-day, 21-day. We also got a golden cross on this one where the 50-day crosses above the 200-day. NNN has a portfolio rank of 12 in my portfolio. They are in accumulation price trend. They did close up 1.65% on Friday, which was a 52-week high. They're up 11.88% year to date. There are 6 analysts that cover NNN with a 1-year price target of $43.33 and a range between $43 and $44. The RSI is moving into overbought territory. It looks like the RSI is also supporting these higher prices, so the RSI is higher than it was at the last high, so that is a good sign. We did get a buy signal on about the 3rd of February, and that is strengthening at the moment. When we look at them in the weekly chart, we can see that they're up 3.33%. The RSI has not yet reached overbought territory. We got a buy signal on about the 5th of January, and that is continuing to strengthen as we move along. We can also see the accumulation is at a 3-year high, and the money flow is in bullish territory. When we look at NNN in fast graphs, we can see they're trading below their fair value and their normal market multiple. They have an AFFO yield of 7.79%. They have a dividend of 5.41%. Their AFFO growth rate is 3.87% over this 13-year time frame. Fastgraphs calculates their fair value at 15 times, and their normal price to AFFO ratio is 15.86 times. They grow their AFFO at a relatively slow rate, but they are pretty steady, and they pay that good dividend. This is Realty Income, symbol O, in a 1-year daily price chart. They have a portfolio rank of number 1 in my portfolio. They are in an overall uptrend. On February the 4th, they did have a blue sky breakout. That's where they passed their previous all-time high. And Friday, they did close at an all-time high. They were up 1.36%. I do have a trim point set on them of $63.37. They pay a dividend of 4.93%, and they grow that dividend 3.53% for the 5-year average dividend growth rate. There are 12 analysts that cover Realty Income with a 1-year price target of $63.17 and a range between $60 and 68 cents. I have a price target on them of between $67 and $68, and that's based on this cup with handle pattern. They've already surpassed their previous all-time highs, setting now all-time highs, and I expect them to run up between $67 and $68, at which point I will consider beginning to do a little profit taking on this particular holding. The 10-year Treasury rate is supportive of the REITs at this particular time as it's declining and getting to the previous lows that we've seen of about 3.95. We'll see if that can continue to hold. The RSI is supporting these increased prices, so we have an RSI that is higher than the RSI when it reached its previous recent highs. We did get a buy signal on this one basically at the end of December. It was a little touch and go during the 3rd of February, but it stayed in a buy signal and is increasing momentum at the moment. We look at the weekly chart. This is also an all-time weekly high close. They were up 3.84% for the week. The RSI is now getting into overbought territory, and we got the buy signal on them at the beginning of the year, and the weekly view and the money flow continues to be in bullish territory. When we look at fast graphs, we can see that they're trading just slightly above their fair value at the moment, which is calculated at 15 times. They're trading at 15.33 times. They are a slow AFFO grower as well, like most REITs. Next, we'll look at OneOK, symbol OKE. This is a pipeline company specializing in natural gas. They had been in a very super uptrend for quite a while. This was related to the AI behind the meter play. Then they went into a downtrend here, which I've indicated with these downtrend lines, and they dropped from their highs of about 110, 42%, down to these lows at around $63 per share. They did finally regain their composure, and they broke above that downtrend line, and then they broke above this upward downtrend line. They are trading above their 5-day moving average, their 21-day moving average. The 50-day is upward sloping. It looks like the 200-day is also possibly upward sloping at this moment after being in a decline since about the middle of last year. The 50-day did cross above the 200-day, so we have a golden cross in this situation. They are in overbought territory. We've had a buy signal on them since about the 20th of January. That's in bullish territory, and according to the histogram, bars, it's starting to lose just a little bit of steam, but still looking pretty strong at the moment. They did close up 1.78% on Friday. That was a 65-day swing high. I have a trim point on them of $80.56. They pay a dividend of 4.97%. They have a 5-year dividend growth rate of 2.15%. Year to date, they are up 17.16%. There are 15 analysts that cover OKE with a 1-year price target of $89.07 and a range between $75 and $90. When we look at them in the weekly chart, they haven't quite reached overbought territory, and we've had a buy signal on them in the weekly view since about the 3rd of November. They did close up 5.22% in the weekly view, and that was a 13-week swing high. When we look at OKE and Fastgrass, we can see that they're trading just slightly above their fair value, below their normal market multiple. They are expected to grow their earnings this year by 7%, the following year 8%, and in 2028, 14%. They've grown their operating earnings growth rate at 15.02%, making their fair value 15.02 times. They do have an EPS yield of 6.33%. Next, we'll look at the PulteGroup. This is a consumer discretionary in the home construction industry. They have a symbol PHM. This is a new holding in my portfolio. I've started somewhat slow, but may get more aggressive here in the near term. They are in an uptrend with basically higher highs and higher lows. The Friday close, they were up 2.64%. That was a 52-week high. They're only about 3.4% from their all-time high set on October the 18th of 2024. A close above that price would confirm a blue sky breakout. I also have a price target on them of $192, and that's based on this cup with handle pattern that did trigger on Friday, giving me the indication that this was now in play. So I'll be watching this price very closely. They do have an RSI that is moving towards overbought. We do have a buy signal since about the 3rd of February on the PPO. I do see the accumulation is at near 50. This is a 2-year chart, so 2-year high. I do have a trim point set on them of $131.21. Year to date, Pulte is up 21.58%. They do pay a dividend with a yield of 0.73%, and the 5-year dividend growth rate is 12.97%. There are 12 analysts that cover Pulte with a 1-year price target of $137.67 and a range between $98 and $159. When we switch to the weekly chart, we can see that they're above the 60 line, moving towards that 70. They do have a bullish configuration on the PPO, and the money flow is in bullish territory. They did close up the week 5.53%, and that is also a 52-week high on a weekly close. When we look at them in fast graphs, we can see that they're trading below their fair value but above their normal market multiple. They are expecting a slight contraction in their earnings for 2026, returning to growth in 2027 by 12% and in 2028 by 16%. This is UPS in the daily 1-year price chart. they are in an uptrend. I have a blended intrinsic value on UPS of $129.85. There are 19 analysts that cover UPS with an average price target of $110.95 and a range between 75 and 130. They do pay a dividend of 5.5%, and they have a 5-year dividend growth rate of 10.18%. I do have a trim point on them at $109.80. It's actually higher than that now. I would say it's closer to $114.27. So I didn't update my notes there. Year to date, they are up 20.21%. They did close, it was above their 5-day moving average on Friday. They are trading above the 21-day moving average, which is upward sloping. The 50-day is upward sloping, and the 200-day is now upward sloping after being on a decline for quite a while. So they had resistance at about $118. They did close above that on Friday. So I could probably turn this to a green color to indicate that it is now support. We do have an RSI that is in overbought condition. The PPO is in bullish territory, and we had a buy signal on the 3rd of February. When we look at the weekly chart, we can see that they were up 1.62% for the week. We look at UPS in fast graphs, we can see that they are trading above their fair value but below their normal market multiple. And after 4 years of contraction in their EPS, this is supposedly the final year of that EPS contraction. It'll be down about 1% is what the analysts expect. Then they return to growth in 2027 at 14% and 2028 6%. Next, we'll look at WP Carey, symbol WPC, in the 1-year daily price chart. They have a portfolio rank of 24 in my portfolio. They are in an uptrend with higher highs and higher lows. They did close up Friday at 1.50%, which was an all-time high. I have a trim point on them of $70.42. Year to date, they are up 15.29%. They do pay a dividend of 4.96%, and their 5-year dividend growth rate is actually negative 2.38%. So they did have a dividend reduction when they spun off their office buildings into a separately held REIT. They are trading above an upward sloping 5-day, 21-day, 50-day, and 200-day. Once again, I always keep an eye on the 10-year Treasury rate, as that affects the REITs to a pretty significant amount. Their RSI is in overbought territory. We've had a buy signal since the 4th of February, and that does seem to be gaining momentum with these histogram bars actually increasing at the moment. When we look at them in the weekly chart, they were up 4.2%, and that was an all-time weekly high close. When we look at them in fast graphs, we can see that they're trading above their fair value, and they're also trading above their normal market multiple. They did have a year of contracting EPS in 2024. They did return to growth in 2025. That's actually confirmed at this point at 6%. 2026, they're estimated to grow their AFFO at 4%, 3% in 2027 and 6% in 2028. And when I said EPS earlier, I meant their adjusted AFFO. If you found this video helpful, please remember to subscribe to the channel and set notifications for future videos. Also, be sure to press that like button to help support the channel. I wish you the best in your investment journey, and remember to trade well. We'll talk to you again soon.